Hello everyone and welcome to our new tutorial moving averages. This tutorial will learn about moving averages, their various and variations of use, how they qualify so easily for automation and self-building and so on. Let's go ahead. Moving average is one of the most versatile and widely used of all technical indicators. The way it is constructed and the fact that it can be so easily quantified and tested. It is the basis for many technical and mechanical trend following systems in use today. Chart analysis is largely subjective. As a result, chart analysis does not lend itself so easily to automation and building trading systems. For example, a double top double bottom pattern or a head and shoulder pattern cannot be quantified, or a set of rules cannot be built to identify them. Whereas you can very easily place a set of rules or formulate a set of rules if you are building a trading system based on moving averages. Moving averages rules can be easily programmed into a computer containing specific buy and sell rules. Common questions in use of moving average. Now, the most common question that we face, or technical analysts face, or people who are new to technical analysis and moving averages face are: which type of average works better? How many days should be averaged? Should a short term or long term average be used? Is there a best setting that can be used for any market? Is closing price the best price to average? Should more than one average be used? Are there times when moving averages works better? As we walk through this tutorial, we will address many of these questions. Moving average is a device with a time lag. Moving average is essentially a trend following device, no doubt about it, but its purpose is to track the progress of a trend. However, it does not predict the market action in the same sense as standard chart analysis attempts to do. For examples, if there are patterns building up, like a head and shoulder pattern, once the right shoulder is completed and once neckline is broken, we know for sure that prices are that a top is complete and prices will now reverse and start falling down. Whereas moving average does not attempt to predict the market. They simply follow the market. Moving average is a follower and not a leader. Never anticipates, only reacts when a price is given to it. It follows the market and tells us that a trend has begun, but only after the fact. The moving average is a smoothing device. By averaging the price data, a smoother line is produced, making it much easier to view the underlying trend. However, the moving average line also lags the market action. A moving average is a smoothing device. Shorter moving average, such as 20-day moving average, would hug a price action much closely than a 200-day moving average. A short-term moving average is more sensitive to price action than longer-term averages. Similarly, in certain market conditions, it is advantageous to use shorter average. At other times, longer and less sensitive average proves more useful. Following is a chart of Union Bank. It's a daily chart, and on this chart you can see I have plotted various simple moving average with various settings on price chart. The one in beige color line is 2-day simple moving average. The one in white is an 18-day simple moving average, and this green colored line is a 200-day moving average. Details of these moving average can be found on your upper screen. You can see here MA stands for moving average or simple moving average. Parameters are close, 2 bar. Next is an simple moving average with close and 18 bar look back period. Next is with close and 200 bar look back period. These moving averages can be found in charts, averages, under average command, average folder. You can see there are various types of simple moving averages, various types of moving average, simple, exponential, weighted, Wilders, time series forecast, double exponential, and so on. Alright, you can see two period moving average is following prices much more closely. You can see most of the time the moving average is in the middle of bar. An 18 period moving average is not that sensitive to price action as compared to a 2-day moving average. You can see 2-day moving average is running up and down and up and down everywhere. 18-day moving average is steadily rising, a shallow dip, and then it continues to rise. And here it starts to fall, keeps on falling. Whereas the 200-day moving average is unaffected, it continues to rise, irrespective of whether prices are going up, down, or anywhere. So, the longer the look back period, the more insensitive moving average will be, and the shorter the look back period, the more sensitive moving average will be. Which price to use? While most technicians in the world use closing price is considered one of the most important price action of the day, there are technicians that use other price value. Like some use midpoint average, which is arrived at by dividing the day's range by 2. Others include closing price in the calculation by adding high, low, and closing price together. Still others prefer to construct price bands by averaging high and low prices separately that result in two separate moving average lines that act as a sort of volatility buffer. Let's see an example. Okay, so following is a daily chart of Tata Motors, and let's plot various types of simple moving average with different settings. Example, I'll overlay a moving average with 4 periods as look back. Okay, and for price field I will take high as my price field. Next I will plot same with look back period of 4, but this time I will take low as price field and I'll change color to something more visible. Okay, gold will do. Next we will plot again simple moving average for same period of 4, and for price field we will take average. What does average do? It takes high and it takes low and it divides it by 2. So that becomes our average. Okay. And for color we will keep bright green. Alright. So you can see I have plotted same simple moving average with same look back period, that is 4-day simple moving average, but using different values, different closing prices. For the first one, for the beige one, I have used high. For the golden one, I have used low. And for the green one, I have used average. So this moving average basically acts as a kind of a band, a sort of a band. If we could adjust the look back period correctly, we can use the extreme point of these bands as support and resistance. Let's see if we can do that. Here I will increase it to something 14, use this to 14 as well, and this to 14 as well. So you can see once prices enter these bands, prices start to consolidate, and once prices are beyond these bands, they show a fair level of trend. You can see here they started consolidating, bands went flat, and here they are consolidating as well. So it simply depends on what look back period you use to make your judgment or to place your judgment. But the idea that I want to know is simple moving average can be used in many different ways for pattern identification of a trend. Types of moving averages. Simple moving average. It is the type used by most technicians, but it has some shortcomings. 1. Only the period covered into average is taken into account for calculation. Second, simple moving average gives equal weightage to each day's price action. Example, in a 10-day moving average, the last day receives same weightage as the first day in calculation. Next is an evolution to simple moving average, that is a weighted moving average. In an attempt to correct the weighting problem of simple moving average, some analysts used weighted moving average. In this case, the closing price of 10th day would be multiplied by 10, the 9th day by 9, the 8th day by 8, and so on. Thus, greater weightage is given to more recent closing. The total is then divided by the sum of multipliers, 55 in the case of 10-day average. However, weighted moving average does not address the problem of including only the price action covered by length of the average itself. So weighted moving average only takes into consideration the number of look back period that we have given it to consider. It does not take into consideration price actions that have taken place beyond look back periods. In order to correct the problem of simple and weighted moving average, a new set of averages were identified called exponential moving average. This moving average addresses both problem associated by simple moving average. 1. Exponentially smoothed average assigns greater weightage to more recent data. Therefore, it's a weighted moving average. Second, while it assigns lesser weightage to past price action, it makes sure that it includes its calculation all of the data in lifetime of the instrument. In addition, the user is able to adjust the weighting to give more or less weightage to more recent day's price action. Following is a chart of Tata Steel. It seems to be in a downtrend, but let's go ahead and add various different moving average, for example simple, weighted and exponential moving average, and see how they behave to price action. For first we will overlay a 15 is default, but we'll use an 18 period moving average. Next we will plot weighted moving average of same 18 period. Next we will plot exponential moving average of same 18 period. So you can see all three moving averages are using same look back period for calculation, but still simple moving average is less rigid as compared to weighted moving average. Weighted moving average is moving very close to price action. This is because weighted moving average gives more weightage to recent price data, whereas it gives lesser weightage to previous price data. Whereas a simple moving average simply calculates average of the given look back period. At the same time, you can see an exponentially moving average gives a somewhat in between performance of simple and weightage combined. You can see it reacts well to price fluctuations, but in a strong trend, it tends to be a bit away as compared to weightage, but well above simple moving average. Every time there is a trend, you can see exponential moving average is in between weightage and simple moving average. At the same time, where weightage moving average is not that flexible when price changes its trend, simple moving average reacts quickly to any fluctuation in price data. If you can see here, you can see here in this price dip, exponential moving average was quick to calculate take into consideration this price dip as it went lower earlier as compared to simple or weighted moving average. So basically simple moving average is, as its name implies, a simple moving average. Weighted moving average is one step above or an improvement to simple moving average, and an exponential moving average is an improvement to both a simple and a weighted moving average. Use of one moving average. The simple moving average is one of the most commonly used moving average. Some traders use just one moving average to generate trend signals. When closing price moves above the moving average, a buy signal is generated, while when closing price moves below moving average, a sell signal is generated. For added confirmation, some technicians also like to see the moving average line itself turn in the direction of price cross. If a short-term average is employed, the average tracks prices very closely and several crosses occur. This action can be either good or bad depending on market volatility and price range. If the average is too sensitive, some of the short-term random price movement will activate trend signals. While shorter averages generate more false signals, it has the advantage of giving trend signals earlier in a price move. The more sensitive the average, the earlier the signal will be, and the less sensitive the average, the delayed entry. So the trick is to find an average setting that is sensitive enough to give early entry and insensitive enough to keep us away from random price action. In the chart below of HDFC Bank daily chart, you can see a 10 period simple moving average has been plotted in dotted green lines along with a 50 period simple moving average in beige colored line. And if we were to use only one average for our price entry and exit method, the method is simple. Every time prices closes above its 10 period MA, take a buy entry. Every time price closes below 10 period MA, take a sell entry. Arrows are marked to tell us when prices triggered entry and exits. You can see following a 10 period or following a simple moving average, a single simple moving average will give you entry and exit. But number of entry and number of exit depends on the time period that you choose. A 50 period moving average will give you lesser entries and exits. But if a major price reversal was to occur, 50 period moving average will give you late entry into the price action. As you can see here, this price trend 50 period moving average could have given an entry at this price, whereas a 10 period moving average gave an entry at this level. So in a trending market, a shorter term moving average will give us early entry, but it will also give trigger entry in random price moment or some corrections, whereas a longer look back period will keep us away from such random price action. But in a trend, they will also trigger us late into the setup. While the longer moving average performs better when trend continues to be in motion, it gives back a lot more when trend reverses. The insensitivity of longer average, which kept it out from getting tangled up in short-term corrections during the trend, works against the trader when trend actually reverses. So the longer average works better as long as trend remains in force, while a shorter average is better when trend is in process of reversing. It becomes clear, therefore, that the use of one average alone has several disadvantages. It is usually advantageous to apply two or more than two moving averages. Use of two averages to generate signals. This technique is called double crossover method. This means that a buy signal is produced when a short-term average crosses above longer one. For example, two popular combinations are 5-day and 20-day moving average and 10-day and 50-day moving average. In 5-day and 20-day moving average, a buy signal occurs when 5-day average crosses above 20-day moving average. Similarly, a sell signal occurs when 5-day average crosses below 20-day moving average. In using this technique, the two averages together lags the market a bit more than use of a single average, but they produce lesser whipsaws. Following is a daily chart of Tata Steel, and on this chart I have plotted a 20-day simple moving average and a 5-day simple moving average. Now, if you're using AMI Broker, you can change its parameter by right clicking on your chart, selecting parameters. You can see parameters for various prices or various indicators are given. Price, color by default, we are not going to touch this. Moving average, price field is close, period, SPY, and color. And style, what kind of style you want. For example, if you want your smaller moving average to be dashed or dotted, you can click this. You can see 5-day moving average got dotted. If you don't like this, you can untick it and turns into line again. Or if you want your longer term moving average to be thick, more visible, can make that into style. Click thick. Can see 20-day moving average has turned thick. Okay, that looks good. We'll keep it. So you can make various changes to your moving average in preference window. All right. This is daily chart of Tata Steel. Plotted is 5-day moving average crosses above 20-day moving average. We will take an entry signal. Here it gave triggered a sell signal, triggered a buy signal here, triggered a sell here, triggered a buy but never gave a buy signal but never triggered it, and sell signal continues. So using two moving averages, though it lags the market a bit more as compared to use of a single moving average, but two or double moving average will keep you out of whipsaws or corrective price moves. And since moving averages are trend following system, they will keep you in a price trend for longer period of. Our next example is a daily chart of TTK Prestige, and for this example I have plotted a 50-day moving average in blue colored thick line and 10-day moving average in beige colored thin line. You can see they gave entry and exit at very good price levels, and they kept us away from various fluctuations or corrections or consolidations. You can see here price this method kept us away from this corrective moves in here, kept us away from this corrective move as well. So an entry was made at this price range when 10-day moving average crossed about 50-day moving average, and they kept us, if we say prices triggered on April 2014, so they kept us well into trend until July 2014 till here. But this is one of the core problem faced by moving averages. If you take higher time frame setting, you can see most of the gains were given back because this moving average is more insensitive to price fluctuations, though it will keep us away from various whipsaws or corrective moves, but they will also give back its profit the time trend changes its direction. A sell trade was triggered here and it was covered at this point and triggered a buy trade. So if you take longer look back period, chances are you will be in a trend for longer amount of time, but you will there are also chances that you may lose most of your gains if prices were to reverse quickly. If you take a sensitive and lesser look back period moving average, chances are you will get stopped out and you will have more whipsaws. But if there is a change in trend, it will be triggered much more earlier as compared to a longer look back period moving average setting. Now let's go ahead and I'll add one more window. To this window, I will add moving average with 20 and 5-day setting. Okay, I'll make it 5 and sky blue thick. I'll make it 20. So here you can see where prices give a buy, triggered a buy on 10 and 50-day moving average at the start of a very good trend. Here they triggered, whereas 5 and 20 triggered us into a trade earlier as compared to 10 and 50. But then they stopped us out at this point. Here stopped us out and triggered into a short trade. Stopped us out and triggered into a long trade. Stopped us out, triggered into a short trade, and stopped us out here, triggered into a long trade. So if we were to compare both side by side, you can see 50-10 setting gave us a sell signal at this price range, somewhere around 4000 levels, whereas 25 gave us a sell signal at the range of 4400 levels. So this is one of the advantage, whereas as well as disadvantage of using moving average setting. If you use a setting that closely follows price action, chances are you will have more losers or more whipsaws. If you're using longer look back period, chances are you will stay into a trend for longer time, but you'll also give back most of your profit if prices were to reverse. Hence, it is better to use an optimum setting, or it is better to use two moving averages in or two moving average system in harmony. For example, you could use a 50 and 10-day moving average to take direction of prices. As you can see here, when 10-day moving average crossed below 15-day, we could assume that prices are now trending lower or they are into a bear mode or a selling mode. And then we could go ahead and use 20 and 5-day moving average for our sell trade triggers. For example, a sell trade was triggered here, sell trade triggered here, and that's it. So there is limitless scope of how you could use moving averages to build your trading system. But one needs to take care that you find an optimum level of setting that would keep you in a trend for longer period, at the same time keep you away from short-term random price movement. One of the evolution to double crossover method is triple crossover method. The most widely used triple crossover system is popular 4-day, 9-day and 18-day moving average combination. This concept was first mentioned by R.C. Allen in his 1972 book, How to Build a Fortune in Commodities. The 4-day, 9-day and 18-day moving average system is a variation of 5-day, 10-day and 20-day moving average numbers which are widely used in futures market. How to use 4-day, 9-day and 18-day moving average system. It's already explained that shorter the moving average, the closer it will follow price action. Therefore, 4-day average will follow price trend more closely, followed by 9 and then followed by 18-day average. Therefore, in an uptrend, 4-day average needs to be above 9-day, which again needs to be above 18-day average. In a downtrend, the order is reversed and the alignment is exactly the opposite. That is 4-day below 9-day followed by 18-day. A buying alert takes place in a downtrend when 4-day average crosses above both 9-day and 18-day average. A buy signal is confirmed when 9-day average also crosses above 18-day average. This places 4-day above 9-day, which is above 18-day. Intermingling may occur during corrections or consolidations, but the general uptrend remains intact. Some traders may take profit during intermingling process and some may use it as a buying opportunity. When an uptrend reverses to the downside, the first thing that should take place is that shortest and most sensitive average, 4-day average, dips below the 9 and 18-day. Then, if longer 9-day average dips below 18-day average, then a confirmed sell signal is given. Following is a chart of Godrej Industries, and you can see there are three moving averages plotted on the chart. These are 4-day, 9-day and 20-day moving average. You can see here the settings. Page 1 is 4-day, the blue one is 20-day, whereas the green one is 9-day moving average. So as per triple moving average or triple trading system, what it tells us is if 4-day moving average falls below 9 and 20-day moving average, it's a signal that trend might be changing. Here on 9/18/2014, 4-day fell below 9 and 20-day moving average, and on 23 September, 9-day moving average, that is the green colored line, fell below 20-day moving average, thus signaling confirming the down trend, which continued till 10/31 or October 31, when 4-day went above 9 and 20-day average, and on 11 on 5 November it confirmed a buy signal. It gave a buy signal, or it confirmed the uptrend, which turned out to be nothing but corrective upside move, and then prices gave us a sell signal on confirmed sell signal on 21 November, which continued till here 31st December. And in the meanwhile, you can see 4-day moving average was giving a change of trend signals, kept on giving change of trend signals. For example, it gave a change of trend signal which could never get confirmed, gave a change of trend signal here which was confirmed, change of trend signal at this price here which was confirmed, and it gave when prices were bought and bought into a upside trend, it gave a change of trend signal here which could never get confirmed, and prices continued to trade higher. Change of trend signal given on these price levels, and you can see green line or 9-day moving average did dip below 20-day moving average here on three occasions. On 3 days it dipped below 20-day moving average, but prices kept on rising higher instead of coming down. So even though change of trend signal was given, it was never triggered and prices continued to trade higher. Our next example is a chart of Jet Airways, and as of on the chart you can see various moving averages have been plotted. That is, the system of 4, 9 and 20-day moving average has been plotted, and It seems there were a lot of change of trend and confirmation signals given, but let's go ahead and dissect them. How many were actually triggered and what happened in this fairly volatile up and down yet downside moving market. On starting from the left, you can see a buy signal was given, but it was never confirmed as the green line kept trading below 20-day moving average. Here on this price, yes, on this price range, buy signal was given as 4 gave a buy signal a day before, and on 3rd July buy signal was confirmed, which was further confirmed by prices taking out high, making a new high the next day. And on 14 July, sell signal was given when 4-day crossed below 9 and 20-day moving average, and on 18 July, sell signal was confirmed but was never triggered at this price level as the next day prices failed to make new low. But if we were to follow the price range, you can see 9 and 4-day continued to stay below 20-day moving average, giving us a bearish hint. But we want 4-day to be below 9-day and 9-day to be below 20-day to consider it as a valid sell signal. So which took place on this day. But again, we were not triggered as the next day prices failed to make new low. Continuing here on this, on 21 August, 4-day went below 9-day and 9-day was already trading below 20-day. And the next day prices took out yesterday's low and made a new low. So sell trade was triggered on this day, and if we followed, bullish hint was given, never confirmed. Bullish hint was given, never confirmed. Bullish hint was given on this large upside day, but then 4-day fell below 9-day. Here 4-day went above 9-day and continued to stay above until prices took out high of previous day, which it did on this day on 30 October here. And we can see now moving averages are aligned in the right position to tell us that prices are now trending upside, as they did here when they told us that prices are now trending downside. Here they are telling us that prices are now trending upside. Let's go ahead and see, and you can see prices did broke out to new high. It gave a sell signal here when 4-day went below 9-day and 9-day went below 20-day, which failed miserably, and a buy signal was triggered here, confirmed by a new high, and prices continue to trend higher. So 4-day, 9-day and 20-day moving average will help us to identify and help us take early entry into a trend. At the same time, they help us in staying away from most of the whipsaw price action or consolidating price action. As we can see here, they did confirm the trend, they did signal a change in trend, but very few times they confirmed trend direction. So that brings us to Bollinger Bands. The simplest way to use Bollinger Bands is to use the upper and lower band as price targets. If prices bounce off the lower band and crosses about 20-day average, then the upper band becomes the upper price target. A crossing below 20-day average would set lower band as lower price target. In a strong uptrend, prices will usually fluctuate between upper band and 20-day average. In that case, a crossing below 20-day average warns of a trend reversal to downside. Similarly, in a strong downtrend, prices will fluctuate between lower band and 20-day average. A crossing above 20-day average warns of a trend reversal to the upside. Bollinger Bands expand and contract based on their average look-back period volatility. During a period of rising price volatility, distance between the two bands will widen. Conversely, during a period of falling volatility, the two bands will contract. When the bands are unusually far apart, that is often a sign that current trend might be ending. Similarly, when distance between two bands have narrowed too far, that is a sign that market might be about to initiate a new uptrend or initiate a new trend. Bollinger Bands work best when combined with overbought and oversold oscillators. Following is a daily chart of data Steel with 20-period Bollinger Bands and 20-period moving exponential moving average applied to it. Taking a look at Bollinger Bands, you can see prices touched Bollinger Bands and they tend to reverse. A pullback came after touching Bollinger Bands. Very few are the cases where prices continue to follow along the lines of Bollinger Bands. One case is here, another case is here, and then it is here. When prices touch Bollinger Band and continue to walk with Bollinger Band, it is a sign of a strong trend. In a regular trend, prices tend to oscillate between Bollinger Band and moving average. And when prices are oscillating between extremes of Bollinger Band, it is usually a sign of consolidating or corrective price move. As you can see here, a consolidation was in place when Bollinger Bands touched both the levels, and here we could identify a downtrend when prices tend to oscillate between lower Bollinger Band and moving average. Similarly, an uptrend can be identified when prices tend to oscillate between upper Bollinger Band and moving average. So Bollinger Bands can be used in multiple ways to identify market condition. As you can see here, they help us understand if a market is trending. They help us understand the degree of trend. They help us understand if they are trending or consolidating. And then they help us understand volatility of price action. For example, when price action was less or limited or sideways, Bollinger Bands continued to stay closer to each other. When volatility increased, Bollinger Bands increased their distance, suggesting us that an increased volatility in market condition. You can see here the strong pullback was reflected in Bollinger Band by expanded Bollinger Band. The contracting price action was reflected by contracting Bollinger Band. The upside surge, upside momentum was reflected by increasing size of Bollinger Band. So Bollinger Band can be used for multiple purposes. They help us identify overbought and oversold zones. The extreme bands help us identify. They help us identify volatility in the given market. They help us identify the degree of trend. They help us identify the trend direction. And hence, Bollinger Band stands to be one of the most widely used indicator and one of the most popular indicator among technical analysts. Moving averages tied to cycles. Many market analysts believe that time cycles play an important role in market movement. Because these time cycles are repetitive and can be measured, it is possible to determine approximate time when major market tops and bottoms will occur. The subject of cycle is introduced here only to make point that there seems to be a relationship between the underlying cycle that affect a certain market and the correct moving average to use. In other words, the moving average can be adjusted to fit dominant cycle in each market. There appears to be a definite relation between monthly cycles and moving averages. For example, moving monthly cycle is one of the best known cycles operating throughout futures market. A month have 20 to 21 trading days. Cycles tend to be related to the next longer and shorter cycles harmonically or by a factor of 2. That means that next longer cycle is double the length of cycle and the next shorter cycle is half its length. Therefore, monthly cycle may explain the popularity of 10, 20, 25 and 40-day moving averages. The 20-day measures monthly cycle as there are 20 to 21 trading days in a given month. The 40-day average is double of monthly cycle. The 10-day is half of monthly cycle and 5-day is quarter or half of half monthly cycle. Even the commonly used moving average settings like 4, 9 and 18, which are derivatives of 5, 10 and 20, can be explained by cyclic influences and harmonic relationship of the neighboring cycles. Following is a daily chart of Tata Steel, and we have applied a 20-day moving average in thick beige color along with a 4-day exponential moving average in blue colored line. And it stands to reason that if prices are trading below its 20-day moving average, then it is safe to assume that prices are trending to the downside. If prices are trading above its 20-day moving average, it is safe to assume that prices are trending to the upside, towards upside. So if we look at this chart in terms of cycle, we can understand or we could make an understanding that prices are trading below its 20-day price cycle. Chances are prices are trending lower. And if its quarter cycle, that is a 4-day cycle, is taking place below its 20-day cycle, then it is safe to assume that direction is towards downside. If 4-day cycle is operating above its 20-day cycle, it is safe to assume that prices are trending towards upside. As we can see here, 4-day swinging above 20-day makes a new high. 4-day swinging operating below 20-day makes a new low. Swing and new low, swing and new low, swing and new low, swing, change in trend, swings up, swings down, swings up, swings down, swings up, swings down, and starts swinging below its 20-day average, suggesting us that short-term cycle is operating below its long-term cycle and prices are trading below its long-term cycle. Thus, all in all, prices are every condition suggests us the 20-day cycle is operating towards downside and 4-day cycle, that is short-term cycle, confirms the action of 20-day cycle by producing swings that are lower or below its 20-day cycle. If we were to follow this price action, prices cross above its 20-day, 4-day swings start swinging above 20-day, a swing above 20-day, crosses below, swings up again, another swing about 20-day, and so on. So this example clearly suggests us that there is a close relationship between time cycles and moving average settings. So that brings us to our last topic, pros and cons of moving average system. One of the great advantage of using moving average as trend following system is that they embody one of the oldest maxims of successful trading. They trade in the direction of trend, they let profits run, and cut short losses early. The moving average system forces user to follow rules by providing specific buy and sell signals based on those principles. But because they are trend following in nature, they are best when markets are in trending period. They perform poorly when markets get choppy and trade sideways for a period of time, and that may be a half to a third of a time. The fact that they do not work that well for a significant period of time is a compelling reason why it is too dangerous to rely heavily on moving average technique. In certain trending market, moving averages can't be beat. There is no two doubt about it. But at other times, a non-trending method like overbought and oversold oscillators is more appropriate. Having said that, no matter what trading system you build with the help of moving averages, or either a trending or an oscillating or a non-trending system, it is always better to heavily backtest your idea, understanding defects and shortcomings of your method before implementing or taking them live. But moving averages are one of the most widely used technical indicators for system building and backtesting, as they are so easy in formulating entry and exit rules. With that said, we will close our tutorial on moving averages.